So in the last month, the stock market has seen more red than an all Elmo costume party, which is kind of an interesting visual, but while investing when share prices are going down feels like a scary move, this is exactly what we dividend investors have been waiting for. All this red in the market is creating some great opportunities to swoop up some more shares of your favorite dividend stocks at a discount, and in this video, we'll be discussing 3 stocks that seem like particularly great buys as we head into September. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. Anyway, the first one on my list is going to be Realty Income, which is officially under $60 per share. And from what I've noticed, a sub 60 share price seems to be the buying threshold for many investors, including myself. I actually picked up a couple more shares of Realty Income this week. And looking at their share price performance, just in the last 30 days, Realty Income is down 9%, which is a very substantial drop and has them inching closer to their 52-week low there. Looking at their year-to-date performance, they are down about 10%, so most of their losses so far in 2023 have come just in the last month, and then zooming out over the last year, they are down almost 19%, so pretty big drops all across the board. Which begs the question, why is Realty Income, which is highly regarded as being like the gold standard of real estate investment trusts, but anyway, why is this company down so much? And it's actually pretty simple. It primarily has to do with interest rates. Right now, the 10-year treasury yield is the highest it's been since like 2007, and when interest rates go up, it can impact real estate investment trusts like Realty Income in a couple of ways. First off, obviously, when it comes to anything related to real estate, debt is an important tool. Real estate investment trusts will borrow money to buy more properties, but when interest rates go up, it makes borrowing that money more expensive, which cuts into the cash flow on the deal. Furthermore, if these companies have variable loans where the rates can fluctuate, higher interest rates will have an impact there as well and will increase the amount of interest expense the company has to pay. Another issue with rising rates is that it creates competition for real estate investment trusts in the sense that other income investments may start to look more attractive. When interest rates are going up, other income producing investments like bonds or high yield savings accounts start to look more attractive, which will reduce the demand for real estate investment trusts, which can push their share prices down. Despite this though, on an individual level, Realty Income is still very fundamentally strong, and as that share price goes down, it pushes that dividend yield up. And on that note, taking a look at the dividend stats, the forward yield is sitting at about 5.4%, which is considerably higher than the 4-year average dividend yield by about 1%. So the cash flow return right now is a lot nicer than it historically has been. And looking at the rest of the dividend stats, the payout ratio is coming in at about 74%, which is not bad for a real estate investment trust. And the 5-year growth rate's looking okay. I mean, 3.75%. It's not the highest we've seen, but Realty Income does have a high yield, so there's a bit of a trade-off there. And Seeking Alpha says the dividend growth history is only 2 years, but Realty Income is actually a dividend aristocrat and has made 103 consecutive quarterly dividend increases, which, as I'm sure you can imagine, stretches longer than 2 years. Anyway, moving on to the second company, we're talking about WP Carey, another real estate investment trust that is down just about as much as the first one. In the last month, WP Carey is down about 9.5%, so just a little bit more than what we saw with Realty Income, and they're also getting pretty close to being at their 52-week low. But then if we zoom out, looking at the year-to-date performance in 2023, they are down 16%, so quite a big drop this year. And then if we zoom out once more over the last 365 days, they're down almost 24%. And as I'm sure you can imagine, WP Carey is down for more or less the same reasons as Realty Income. It's just higher interest rates pushing the share price down, and as we can see here, it's impacting the entire real estate sector. Pretty much every REIT is in the red. But anyway, looking at WP Carey's dividend stats, starting with the forward yield, it's coming in just below 6.6%, so a much higher yield than what we were seeing with Realty Income, and this is also about 1 percentage point higher than the 4-year average yield, so that's looking good. And then regarding the rest of the dividend stats, the payout ratio is coming in at about 81.5%, so it's starting to get a bit up there on the higher end. And then if we look at the 5-year growth rate, this is only like 1%, so it's hardly even there. But once again, just like with Realty Income, it's a bit of a trade-off. We're getting that nice high yield from WP Carey, but it's coming at the expense of very minimal dividend growth. But anyway, guys, we will take it, and then the dividend growth history is looking pretty solid at 12 straight years of growth. Overall, I think WP Carey looks like a pretty solid buyer right now, and I'm actually going to be picking up some more shares of this company in my own portfolio here in the near future, seeing as I'm getting to be down a decent amount. Looking at my position here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to grab this in the description of the video. I hope you check it out. But anyway, looking at this, I have just over 22 shares of WP Carey at an average cost of $69.80, and with a current share price of $65.63, I'm getting to be down a decent amount. Like I said, it looks like I'm down about 6% just in terms of share price, so I definitely have some room to average down here. And with that, guys, we are moving on to the third stock of the day. This one is going to be Target, who is down quite a bit in the last month. They've dropped another 7.8% just in the last 30 days. On a year-to-date basis, they are down about 18.6%, so a pretty big drop so far in 2023. And then zooming out, looking at the last year, they are down 24.3%, so another very big drop, which puts Target right there at their 52-week low. Now, like many companies, Target reported their quarterly earnings this month where they missed on revenue but beat on earnings, and initially I thought this was the catalyst for this month's drop in price. Looking at the chart here, the company actually gained after reporting their earnings, and the drop in share price didn't come till a few days later here on the 21st and 22nd, where it really started going downhill. And this is the same day this Seeking Alpha article came out pointing to a substantial rise in retail theft that has been hurting companies like Dick's Sporting Goods, Lowe's, Walmart, and of course Target. And this was a common theme mentioned in all of these companies' recent earnings calls, and in the case of Target specifically, they reported a 120% jump in incidents just in the first 5 months of the year. At any rate, this had a pretty big impact on Target's share price, and right now has the company looking more attractively valued than usual. Taking a quick look at some of these valuation metrics, starting here with the PE ratio, this is sitting at 16.23, which is not too shabby in its own right, but this is 13% below the company's 5-year average, so there's a little bit of a relative discount there. And then scrolling down, looking at the forward price to book, it's sitting at 4.4, which is okay, but this is about 25% lower than the company's 5-year average price to book. And then the forward price to cash flow is sitting at 7.9, very nice and low there in the single digits. And this is also 27.4% below the company's 5-year average price to cash flow. And then switching gears and looking at Target's dividend stats, the forward yield is coming in at about 3.6%, which is extremely high for this company in particular. In fact, it's about 52% above the company's 5-year average dividend yield, so that's looking great. And then the rest of the stats are looking really good as well. A payout ratio just under 60%. I don't mind that. The 5-year growth rate's looking fantastic there in the double digits, 11.6%. And then Target is a dividend king with 54 straight years of growth. You gotta love that. But anyway, guys, those were the 3 stocks that I really wanted to dive a bit deeper on today, but there are still so many more great companies out there that I think you need to keep your eye on. One of which is the Southern Company, who's dropped 6.6% just in the last 30 days. And if we look at their performance over the last year, they are down 13.5%. So definitely keep your eye on this one. Next up, also keep your eye on Starbucks, one of my favorite companies, who's down 7.4% just in the last month. And their share price is starting to get down there, under $95 per share. And if they can somehow manage to keep that going and get under 90, it'll be a really, really strong buy, I think. That's when I'll start adding more shares to Starbucks at least. Moving on, you gotta keep your eye on Discover Financial Services, who was down 16.5% just in the last 30 days. They really dropped off a cliff right here, which I'm guessing is when they reported earnings. But anyway, this puts them at a 14% loss in the last year, so pretty much all of these losses and then some have come just in the last month. Next up, UGI Corporation. Keep your eye on this one, guys. They are down 13.33% in the last 30 days, which puts them at a loss in the last year of 43.2%, so a very big drop. And UGI is sitting at their 52-week low. Moving on, another one, guys, is the Hershey Company, who's down 12.2% in the last 30 days, so a pretty big drop for this company, actually, and it looks like they're sitting pretty close to their 52-week low. But anyway, in the last year, they are down about 7.5%, so all of these losses and then some have come just in the last month. Moving on, another one to keep your eye on is Bank of America, who's back down under $30 per share, and in the last month, they are down 11.4%, guys, but then in the last year, this puts them at a 16.75% loss, or 16.8% now. Anyway, next up is Qualcomm. Keep your eye on this one. They are down 10.4% just in the last 30 days. A lot of double-digit drops in the last month, I'm noticing. But anyway, in the last year, they are down 21%, so quite a big drop for Qualcomm. Next up is Nike, who's almost down double digits in the last month, down 9.7%, but then in the last year, they are down double digits, down 11%. Anyway, guys, next up, keep your eye on American Tower Corporation, who's only down about 4% in the last 30 days. Still a big drop, but definitely not as substantial as any of these other companies we've looked at. But if we look at their performance over the last year, they are down quite considerably, down almost 33%, so definitely a good one to look at, and they are pretty close to their 52-week low. Anyway, moving on, next up is Vici Properties. They are down quite a bit in the last month, down about 7%, and then in the last year, they've also seen, kind of a similar drop, down 9%, but either way, I think Vici's looking like a great buy. And speaking of great buys, next up, I've got 5 more stocks that are the complete opposite and are ones that you should never buy again. All 5 of these stocks are ones that I would consider to be yield traps, and you should avoid them at all costs. So click right over here to find out why, and I'll see you in the next one.